Okay, so a couple specialty topics I wanted to just touch on today. Let's see if we can just quickly go through them. Level tours, you'll be doing this probably in about I don't know, maybe about a month or so. The cut reports. So just really simply put, I don't really like to follow the small specs. Usually they're wrong. Usually they're on the wrong side of the market. The people that I'm going to follow in this report, in green, this is large institutions. They would be like the Goldman Sachses and all that of the world. That's those guys. And in teal, this is the commercials, or basically the people that are actually in the business of whatever the actual commodity is, and they need the commodity. And, in this particular case, this would all be about, of course, banks and stuff. But try to understand that the people that are in the business of, it doesn't matter whether it's currencies, whether it's crude oil, whether it's gold, whether it's, live hogs, live cattle, it doesn't really matter. The people that are in the business, they don't want price volatility. If anything, what they want is they want some way to get rid of the price volatility. That's the whole point of the quote unquote commercials. Is it's a completely different category of customer for the commodities industry. They do not mark the market on a daily basis. There's no such thing as margin calls for them. In fact, the margin to put on a quote unquote hedge trade is substantially different than a regular futures trade. And they are primarily tasked, and this is the important thing that you need to understand, they are primarily tasked to identify what the prevailing trend is and then have their clients take the opposite trade. Remember, this is a hedge. They're not in it to make money. Textbook wise, and of course we go into this in great detail in the level 2 program, what they really want to do is they want to exchange price risk for like Kellogg's Corn Flakes or the farmer that produces corn. They want to get rid of this price volatility and they want to exchange that for what they call basis risk. So if we look at this corn price, what you should see is that it looks like the large institutions are actually looking for some sort of top, where you can see that they've broken down here through there. So the trend is actually, and it would make sense that this market would go into contango or normal healthy market state if indeed that the market was actually pricing in a top. At the same time, too, the commercials, remember, they want to get the trend exactly wrong. They want to be on exactly the opposite side of the market because they're exchanging price risk for basis risk. So they don't really care about actually making money, like net capital gain or loss on the futures contract. What they want is they want for their clients to be able to not have to go through whatever the price movement is. So in this particular case, you can see a very wide bottom in the commercials, which to me says, and keep in mind, commercials is the exact opposite of the market. So this wide bottom or a base or bullishness in the commercials is actually bearish of price. Commercials are not going to make money because remember, they're hedging, so they just offset exactly whatever happening in the industry. But the large institutions, Goldman Sachs, Joey Diamonds, Merrill Lynch's, all that crap, they facilitate the trade for the commercials. So that means by definition, they have no choice but to make money. So if the commercials are bottoming here, big wide W, then that means they think the price is going to go down. And The large institutions facilitate the trade. What letter of the alphabet do you see in the large institutions? Should we be thinking that's bullish or bearish of price? And remember, these guys, they have no choice. They have to make money from the trade. And right there, that's a pretty darn big bearish vote in the marketplace. Actually, it might be interesting to do the stock market. Let's see what we got here. Interesting. Look how the small specs, they've been buying. And what's the price been doing on the Dow? Going down. So the small specs are giving up and now they're selling. And what's the price? What's the market going to do? The market's going to rally here. Can you guys see that? That's absolutely perfect. Look at that M, another M. And so what does the stock market do? The stock market rallies. That's probably that's the perfect analogy to end the broadcast. The public is always wrong. Hey, Gertie, let's go and buy the stock market. All right. And bam, destroyed. Yeah, you know what? We probably should sell. Let's get the hell out. Bam, here comes a rally. Absolutely perfect. Isn't this incredible, this rally that they've engineered out of nowhere here? 650 points, 2% rally. Didn't I tell you guys that if we get more than a 2.5% rally in the market, the smart money starts paying attention? So how ironic, eh? Jesus, this business is so bloody cliche. It's ridiculous.